All right, welcome back, everyone. Let's jump right in. If you're the kind of person who loves dissecting data to figure out exactly how a business ticks, you are in the perfect place. Today, we're taking a top-down anatomy of a stock approach to analyze a genuinely fascinating company, Interdigital Inc., trading under the ticker symbol IDCC. We're going to break down its financial vital signs step by step using the hard data to see exactly what is going on under the hood. 1,740.31%. Let that sink in for a second. That is IDC's 20-year total return. If you're a focused learner trying to map out how wealth is actually created, a number like that immediately sparks a very specific question. What kind of financial engine drives that kind of massive compounding over 2 entire decades? Now, before we get completely swept away by those long-term gains, we need to stay objective here. Massive returns rarely happen without some serious volatility, and IDC is definitely no exception. This stock goes through some wild swings. I mean, in 2022, it dropped 29.26%. But then, it rocketed up 123.68% in 2023, followed by another massive 81.06% gain in 2024. So it's a high-performance vehicle, but it is for sure a bumpy route. To make sense of this massive wall of financial data, we're going to use a really simple roadmap for today's explainer. 1. Historical performance. 2. Unpacking the profit engine. 3. Financial health and dividends. And 4. Valuation and fair price. Kicking things off with Part 1, historical performance and returns. If we look past that giant 20-year number, what's really interesting is just how consistent the compounding growth is across multiple recent timeframes. Consider the 10-year return, 641.39%. Over the last 5 years, it's up 437%. But the real standout? The short-term momentum. The trailing 12-month return is a massive 83.16%. And as of April 2026, the year-to-date return is already sitting at a very healthy 11.40%. The momentum here is undeniably strong. Which brings us to Part 2, unpacking the profit engine. So we know how fast this car goes, but popping the hood reveals exactly why. 95.07% gross profit margin. Wow. Just let the sheer scale of that sink in. For every single dollar of direct revenue this company brings in, they're keeping roughly 95 cents after direct costs. That is an absolute powerhouse of a foundation. An engine literally cannot run much hotter or more efficiently at the gross level than this. But, gross margin is really only part of the story. To really judge a management team's efficiency, we have to look at ROIC, or return on invested capital. As a quick refresher, this simply measures how efficiently a company uses its available capital to generate profitable investments. Basically, it tells us if management is actually good at turning money into even more money. And this is where it gets crazy. IDCC's ROIC sits at a staggering 45.33%. That means for every $100 invested back into the business, they are generating over $45 in return. But the context makes it even better. That 45.33% is nearly 102% higher than their own 5-year historical average. So this tells us the engine isn't just strong, it is currently running at peak historic efficiency. Taking it right down to the absolute bottom line, after they pay all their operating expenses and an effective tax rate of 13.38%, IDICC still pulls in a net profit margin of 48.72%. Almost half of every dollar they make flows straight to the bottom line as pure profit. Honestly, that is an incredibly rare level of profitability. Moving right along to Part 3, financial health and dividends. A fast engine doesn't mean much if the chassis can't handle the weight of its own speed, right? But looking at the data, IDC's balance sheet is incredibly robust. A debt-to-equity ratio of just 0.43 means they carry very low debt relative to the equity in the business. And a current ratio of 1.84 tells us they have nearly twice as many liquid assets as they do short-term liabilities. They aren't overleveraged, and they've got plenty of cash to handle their immediate obligations. Because they're so financially healthy, they also share the wealth, which brings us to the kind of nuanced dividend story of IDCC. Now, at first glance, a 0.79% dividend yield seems tiny. I get it, but look a little deeper. They've increased this dividend for 3 consecutive years, and over the last 3 years, the dividend has grown at a massive 26.05% compound annual growth rate. So how can they afford to grow it so fast? Just look at the payout ratio, only 17.18%. They're using less than a fifth of their profits to pay that dividend, leaving massive room for rapid growth down the road. All right, the moment of truth. Part 4, valuation and fair price. So we've got a highly efficient, ridiculously profitable company. But here is the catch. Has the market already priced in all this perfection? Impartially speaking, while IDTC's operational metrics are incredible, their valuation multiples are undeniably stretched compared to their own history. Across the board, this stock is trading at a significant premium. The price-to-earnings ratio is currently 29.60, way above its 3-year average of 1954. The price-to-sales is 10.84, up from 7.18. Price-to-book is 8.24, up from 6.64. And the enterprise value to EBITDA ratio sits at 14.52, compared to the historical 10.62. You are absolutely paying a premium today compared to what investors paid over the last 3 years. But ratios can be a bit abstract sometimes. Let's bring all this complex data down to a simple, concrete price tag comparison. As of the latest data, IDDC's current trading price is $353.10. However, when we run a discounted cash flow analysis, which basically projects out all the future cash the company will ever make and discounts it back to today, the fair value comes out to $368.44. That gap between the $353 current price and the $368 fair value represents our margin of safety based on free cash flow. It is tight, just 4.16%. What you should really take away from this is that, according to the cash flow models, the stock is currently priced almost perfectly at its intrinsic value. There isn't a massive discount hiding here. The market clearly knows exactly how good this company is. Which brings us to the ultimate question for today's explainer. We've looked at the jaw-dropping 95% gross margins, the massive 45% ROIC, the rock-solid balance sheet, and the steep historical valuation multiples. The data is all laid out on the table. So, as a focused investor, you have to ask yourself, does IDC's undeniably powerful profitability engine justify paying a premium sticker price today? That is the billion-dollar question I'll leave you to answer. Thanks for joining me to dissect the data, keep learning, and I'll catch you on the next explainer.